there's a high probability the Fed will raise rates twice more this year. Why haven't we seen much of a response from the market?
It's been interesting. The markets, particularly the last few days, have been stock markets more or less have been in a relentless grind higher. It's pretty much 10 or 11 S&P points every single day, no matter what. I think there's a few factors for that. Let's back up and just first look at the interest rate expectations. It's widely expected that more or less 90% probability that the Fed will raise 25 basis points at the September meeting. And last I looked, there was about a 60% probability that the Fed would do so at the December meeting. So yes, there's a very high likelihood of certainly one, but almost more greater than 50% chance of two. One would think that considering all the monetary stimulus that we'd received over the past 10 years, that removal of that stimulus would have some deleterious effects, and we really haven't seen those yet. There's a lot of interesting things. One would think that if you've put in an unprecedented amount of QE, it's certainly unprecedented to unwind it. It's definitely a very big challenge to the Fed. We also have a new Fed chairman. For better or for worse, markets tend to test new Fed chairmen at some point early in their term. But as of now, the Powell term has gone very smoothly. And so it would seem that earnings are good and everything's rosy. And so, what me worry? And so I think the markets really have seen the benefit of that. There are some factors that trouble me, though. One factor is there's a pension fund incentive for companies to invest their pension funds defined contribution plans by mid-September. And I think you're seeing a lot of money flowing into the market from that source. That was a front page story in the Wall Street Journal not too long ago. I'm talking about it in another video if you want to get a bit more into that. But that's going to end in September. And that's one source of money that's coming in that will disappear. Another source of money that's coming in are corporate buybacks. And the Trump tax reform has certainly incentivized companies buying their own stock. There have been all kinds of measures saying that in many cases, perhaps the stock buybacks are really the marginal participant in the marketplace. I did a story on segment on Bloomberg last week, and where I showed what they called the SMART index, and there's an index out there that basically just shows the first half hour of trading in the close, which is interesting because stock buybacks typically take place between 9:45 or 10 o'clock and 3:30 or 3:45. So if you look at that time period, it actually eliminates a lot of the effect of stock buybacks. And what you'd seen was that as the S&P and the NASDAQ have sort of lumbered ahead, that index has more or less fallen off a cliff. That to me shows that the effect of the buybacks. So again, as long as the corporate buybacks are there, you've got this source of liquidity keeping the stock market somewhat afloat. I don't know when or if that the companies choose to back that off. In their earnings statements, most of them have tended to say that they're going to continue to do so. So you do have that source of demand out there in the stock market, or at least reduction of supply, however you want to look at it, as the result of stock buybacks. The other incentive, of course, of stock buybacks toward management is that by reducing the share count, they keep up earnings per share because you're reducing the denominator in the earnings per share equation. Another mitigating factor there is companies have been issuing stock to employees, and to a certain extent, the company buybacks basically reduce the supply. The companies increase the supply when they issue shares to their employees. So then the companies are buying it back with the other hand, giving with one hand, taking it back with the other. So effectively, that is keeping the supply of equities rather constrained in some ways. So that's probably why we haven't really seen much of a setback. The things that can really upset the apple cart are: does the Fed continue to raise interest rates to the point where we invert the curve? Possibly. People. I think that's one of those risks that everybody's so attuned to that it's probably less of a risk than it sounds like. When the Fed has been gradual and not panicky, markets don't necessarily react negatively. But I do have to worry that if you're reducing the source of liquidity from the Fed overall, that definitely starts to spill back. Another worry, of course, is does the bond market back up at the long end, which would mitigate against the inverting of the yield curve. But higher long-term interest rates bring their own set of problems, and that is it makes it a bit more expensive for companies to finance. It makes it more expensive for people to buy houses. Certainly the last time mortgage rates rose in a meaningful way was 10 years ago, and that did not end well. There's a lot of factors that make it very different this time. The nature of mortgages and credit default swaps are very, very, very different. So I don't see that as being the critical risk that it was 10 years ago. But these are the sort of things that are the back and forth. And so one can argue that this can persist for a while. If the companies continue to plow money into their own shares, ignoring the record high valuation measures of the stock market, it keeps the trend in place. And I think that's why you're seeing this move. Every time it looks like people say value's in vogue, it comes back to growth. I'll argue that growth may be another word for momentum, and if that's the case, that's another worrisome sign, because the trend is your friend until one day it's not. Trend is actually a very fickle friend. But I think that's what we're seeing now, is that the buybacks, pension funds, continuing to invest in the equity markets. They see a relatively benign interest rate environment, and we go from there. And it's not really until we see cash or short-term fixed income create a real alternative to equities, which we're starting to, but we really haven't seen it yet. We're actually seeing some fixed income rates creep above dividend rates, but people still want the equity kicker. So until or unless you see a real interest rates that provide an alternative, or there's some other exogenous shock, of which we can go on for days with that, that's out there. Until or unless we see some of those factors change, the equity markets remain sort of in this upward grind, at least through the relatively quiet summer months. Equity investors may be taking vacations. Company treasurers, somebody's in the company treasury department still buying stock, or somebody's in the company treasury department still investing money on behalf of their pension fund. So that's what we're seeing right now, and that's the trend that's in place until we tune in and talk about something different.